Hello, everybody. Hello, hello, hello. Yes, I'm Elizabeth and I work for Simple Successful Stocks. That's my company. It's lovely to be here this evening and thank you so much for being here. So I'm going to talk to you, give you some information over the next 30 minutes about what investing is, why you want to do it, when you should do it, and how you can start. Just to say that I didn't start my life as an investor. I'm not a financial advisor. I'm not a financial planner. I actually was an architect. I still am actually, I still have that profession. But I actually started to learn to invest not out of wanting to make loads of money. It was actually started because I wanted to learn something that my dad had taught himself. He was a self-learned investor, as a way of giving us something to talk about to improve our dad-daughter relationship. And actually money in the UK is still less talked about even than sex. So we have a lot of taboos about money, a lot of kind of judgments about it. It's just not talked about it. And this actually was a way for me to become closer with my dad and become, well, just give us kind of better communication. So I call myself a financial educator now, and that's what I do. So I just have to say at the beginning, as I just said, it's a disclaimer. I'm not a financial advisor, financial planner. My purpose really is to give women the knowledge and confidence to start investing yourself. And you can do it. I have done it and you can do it too. So the first thing is what is investing? So investing is about putting your money into things called assets. So assets can be things like property, it can be stocks and shares or equity, it could be wine or jewellery. It's anything that gives you an income and also grows in value. Now, investing is different from trading, and it's very easy to get the two things confused. So when you're investing, you're buying something and you're holding on to it, and then as I said, it gives you an income and it grows in value. So like property is an investment, you get an income from it if you rent it out, and then it grows in value. Trading and investing is something that you do in the long term. It's a long-term thing. Trading is something that you do more in the short term. So you're buying and selling things in the short term, which could be stocks and shares, hoping to make a profit in the short term. So often when people, often people ask about Forex, foreign exchange, you might have heard that term bandied around. That's trading. So the thing about trading is you really do need to know what you're doing. It's quite technical and it takes a lot more time. Investing, you can start small, you can start simple, and you can do it in a way that works alongside your life, in the time that you have. So why would you want to invest? You need to be clear why you're doing it. So the idea of investing is that you have your money working for you. So if you have a job or if you have a business, we are selling our time for money, and our time is very precious, and often the money we receive for it is not as much as we would like. But if you have an asset, that is creating money for you, that is creating wealth for you independently of your time and at the time that you're sort of selling. And at this particular point in time, it's never more important to create assets, particularly if you're a woman. So women, for various reasons, have a far smaller pension pot than men. 40% less, and this is for reasons which I'm sure you're all familiar with. There's the normal gender pay gap. There's often we're working part-time because we're caring for children, or we might be caring for relatives. We live longer and we've got sort of caring responsibilities. And so that gap between what we're earning and saving and putting into our pension increases over time. So we can't rely, if we're under 50, and even if we're over 50, we can't rely on the government to provide for us for our financial future. At the same time, though, it's not all gloom and doom, because investing in the stock market has never been easier or simpler. It used to be something that was only for people who had loads of money, had lots of time, were from some sort of financial club. There's very simple tools and the technology to invest in the stock market now, and the internet has democratized it. I mean, it has made it accessible to everybody. So there's a few principles that's really important to understand before you start investing, and the one I'm going to go into a bit detail now is what I call the magic of compounding. So this is basically, Einstein called it the eighth wonder of the world. And actually he was right. And it doesn't sound that interesting, but I'm just going to give you a few figures here. You don't, it's not complicated. So basically compounding is the money that you make makes more money. So if, for example, you took £1,000 and you invested it and you got a return of 5%, which is like the average from the UK stock market over time, over 1 year, you'd have £1,050. The second year, you have your £1,050, you leave it in your investment, you get another 5%, and then at the end of that, you have £1,103. Now, if you just left that money, compounding away, you're not adding to it, you're getting on with your life, you're having a great time, at the end of 20 years, you'd have £1,653, and you have done absolutely nothing. So that is the compounding. It's like the magic of money working for you. Now, if you change those figures just a little bit, so say you take your £1,000 and then you start paying in £100 every month. So you've got your £1,000, you're adding £1,200 per year, it's compounding away at 5%. At the end of 1 year, you've got £2,310. At the second year, you've got £3,686. But if you leave it for 10 years or you leave it for 20 years, at the end of that time, you've got your £1,000, you're paying in £100 systematically, you've got £44,000, 316. So once you've taken away the money you paid in, that's £19,000, 316 for nothing. So that is the magic of compounding. And if you put a bit more money in, or you get a better return, or you you start with a greater lump sum, you can harness that force to greater effect over time. So that's what assets do for you. There's amazing things called assets. That's what they do for you. So the opposite of that is something like a liability. So a liability would be like a credit card debt. So the compound, the APR on a credit card, the rate of interest on that is like 17%. So that 17% is taking money away from you rather than compounding, which is increasing your assets, increasing your wealth. So the fourth thing that's important when you're starting to invest in the stock market is overcoming the fear of it all. And it can be very scary. I mean, I remember buying my first investment in my lunch hour at work, and I remember pressing the button and thinking I was going to die. It was so scary because I'd never done it before, and I was very fearful of losing everything. And that's often one of the fears that people come up with. You'll lose everything. Investing is risky and you'll lose everything. That's what people will tell you. So the thing is about the stock market is that the value does go up and down quite a lot. So this is a chart. It's like for 50 years of the stock market. So it stops a bit short of where we are now. But the reason I've showed you it as a kind of graphic is just to show that the stock market over time, it does go up and down. There are certain points in time where it's gone up and down more than the others. So the first blue blob in the middle was the kind of crash of the stock market after the big storms in 1987. And then the one I've highlighted here is the sort of early 2000s, where there's this so-called dot-com bubble, where loads of money was going into kind of the internet companies. And then it was discovered that actually there wasn't anything behind them. So there was this kind of quite steep fall in the stock market. And then again, you can see it's all going up like this, and then it comes down again. This was kind of 2008 in the financial crisis. So as an investor, you do like financial, whenever you read sort of financial disclaimers of financial products, it always says, your investments, could go up as well as down. Now, my experience as an investor, and I've been investing since 2006, is that they will go up and they will come down. And when it comes down, you just won't like it. It feels horrible. And the thing is just to stick with it, knowing that in the long term, what you're wanting to harness, because you can see on this chart, is this underlying growth of the stock market, this kind of exponential growth. You're compounding, your things are compounding away and creating wealth for you. So the other very important thing about investing is that you never want to invest money you can't afford to lose. You don't want to be worrying about your investments. You don't want to be spending any sleepless nights over them at all. And if you are, then it's probably best not to invest. And there's a few simple things that you can set up to make sure that this is the case, because we want our money to provide and protect for us, not to cause us anxiety. So what I always suggest to people is that before you start investing, you have a few things in place. And the first of these is to have £1,000 for expected, unexpected events. So this is, for example, if your, I don't know, your dishwasher blows up, or your car, something goes wrong with your car and you need to repair it, that you dip into that money, and you know it's there to be spent if you need it, but it's there in case of emergencies. Then to put aside a cash safety net. So these are your basic living costs. So the basic amount of money that you need to pay for your sort of necessities, kind of food and your bills and insurances, a tiny little bit of playtime, but just your basic living costs. And you put between 3 to 9 months of that, depending on what you feel safe with, in a savings account, and then you leave it there. And that is to draw on if, for example, you lose your job, or, for example, there's a pandemic. So you've got a resource to draw on should that be, should things not go the way you want. The other thing that's important, following what I was saying about not having liabilities, is to pay off your expensive consumer debt, to work on paying that off before you start investing. And then be clear about your goals. So investing is for the long term, 5, I would say 10 years. So you don't want to be investing money that you would like for like a holiday in 2 years, or to put down a deposit on a house in 3 years. You don't want to lock that money away, because when you need to take it out, the stock market might be low and then you've kind of lost the value. So you set up your money to provide and protect for you. So then, once those things are in place, you can start simple and you can start small. So the first thing that's important is to invest in your financial education. So here you are today, that's what you're doing already, which could be time or could be money. It could be reading things, just educating yourself about money, because money is not something that we are taught anything useful about at school. So often people feel really, particularly women, feel bad because they don't know this stuff already, or they've been thinking about for a while and not getting around to it. And it's not, you shouldn't feel bad about it. Don't feel bad about it, because it's not something that is in our universe. I mean, I only knew about it by chance from my dad. Otherwise, I never would have come across it in a million years. So yeah, deciding to get the financial education is very important. Then what you have to do is you have to decide where you want to invest. And there's basically 3 different options if you're doing it, 3 different options. So the first thing you can do is you can work with an independent financial advisor or a financial planner. And they will sit you down and go through with you, what your long-term goals are, and they will recommend and what you want to invest and what kind of timescales you're looking at. And then they will invest on your behalf, or choose investments on your behalf, and charge a percentage fee for doing that. So you're getting professional advice for doing that, which is great. If you decide you don't want to do that, or you're wanting to start really small, what you can do is invest through something called a robo-advisor. So these are relatively recent things. So an example might be Nutmeg. You might have seen adverts on the tube for them, or Wealthify. And what they do is you fill in a sort of simple questionnaire, and they give you sort of packages of investments. Like the one on Nutmeg, they have like a socially responsible kind of package of investments. They have a sort of one where what you invest in is sort of fixed and not changed. So they offer you these packages, and you choose one that feels right for you, and they adjust on terms of whether they think you're a cautious investor or an adventurous investor, and the fees are quite low, and it's very simple. So you can start with these as like with £1. It's brilliant to get you started. Then if you want to do something a little bit more, take a little bit more time doing it, but it gives you more options as to what to invest, you can use something called an online broker. So this might be for example, something like Hargreaves Lansdown or Fidelity. Some banks also online brokers. So online brokers are like banks, but for investing. So they're digital platforms, and you have to open an account, put some money in, and then decide what to buy. So it does require a little bit more work. It's doing it yourself, and you do need to do a little bit more research. So once you've chosen either your person or a platform, then Then you have to choose yourself a tax efficient pot. So the UK is actually a brilliant place to invest. It's we have lots of tax advantages to investing here. And I'll just run through briefly these different options. But so what you can open, so some of you may already have like a cash ISA. So it's basically a savings account. You put the money in, and then any any money you earn from that is not taxed. But you can also open something called a stocks and shares ISA. So it's an account, and it's called ISA is individual savings account. And what's brilliant about this is that once you put the money, you can put the money in, and then any tax you make, any earning, any kind of profit, wealth you create then is not taxed. It's tax free. So it's a great place to put your investments. The second place you can take advantage of your tax efficiencies is something it is either called a workplace pension, so that will be the pension that will set up you if you're employed, or something called a self-invested pension plan, which is something you can set up yourself. Now, the difference between them is when you can take your money out. So with the pension, you can't take the money out until you're 50. So there's that. Now, that could be a good limitation, because then you don't want to take the money out and spend it. But it means that, if you're investing and you're 30, you might want to take that in consideration. And then the other two here are stocks and shares lifetime ISA. So they are for people who are under 39, want to invest, and are going to use that money for their first property, to buy their first property, or towards their retirement. And then a junior stocks and shares is for your children or your nephews or your nieces. You can open them up for them, put money in, practice investing on their behalf, learn how to do it. You've got lots of time on your side. And then when it's 18, they will take ownership of that, and then that money will be there for them in the future. Okay, so once you've opened your account, you put some money in. This is if you're doing yourself. So you opened your account, you need to put some money in, and that money can either be a lump sum or a regular amount every month. Now, you can start with a robo-advisor, you can start with £1. With other sort of online brokers, it's £25 a month. Now, ideally, if you're kind of creating a good sort of wealth habit for yourself, the ideal is to put in 10% of your net income towards your financial future every month, and to get that sort of automatically going from your current account into your investing account without you having to think about it, to set it up so that it's as automatic as possible. Then, when you've got your account, you've got your money in it, you then have to buy something with it. And this is the place that people often overlook. So when you open an account and put some money in, it doesn't mean that it's invested. You have to choose what you're investing it in. Now, if you want to keep your investing very simple and straightforward, there are these things called index trackers, which are low cost, low risk ways of investing. So if you remember, I showed you that chart, the orange chart with the FTSE All Share. I'll just go back to it actually, because I'll need this. Okay. So what this chart is showing is it's called an index of the stock market. So often on the news, they talk about the FTSE All Share. And that is an index which measures the value of all the stocks and shares on the stock market, sort of day by day. And what you can do is you can buy investment funds that follow these indexes. So for example, if you put your money in an index tracker tracking the FTSE All Share, what you would then do is your money would go into a pot, and you would own probably 500, 600 little bits of companies on the FTSE All Share. And then as the FTSE All Share went up or down, your investments would go up and down as well. But what you would do by doing that is that you'd spread your risk amongst 500 or 600 companies, and then you would be taking advantage of this underlying growth of the stock market. So it would, it would go up, it would go down, but in the long term, it should increase in value. So index trackers are a very good way of investing, because what they do is they take away feelings. So one of the key things about investing and being a successful investor is being disciplined, being consistent, and not having any feelings, which is very difficult when the value of your investments goes down. It's almost impossible. I know that for myself. However, if you put it into something that is, you're not making it an intuitive judgment on it, you're not taking a tip from someone down the pub, you are putting it somewhere where it's locked in and a computer is making that decision, you can then take those feelings out of it. And what's great about them is you've got your risk spread across lots of different companies. Now, you can buy these index trackers. You can buy them following the UK stock market. You can buy them following the American stock market. You can buy them following gold. You can buy, there's lots and lots of different ones that you can buy. And the idea is to have a spread of kind of different companies and then different sectors across different parts of the globe. So then if one part, so the UK, for example, the stock market in the UK last year as a whole came down 9%. So that wasn't brilliant for UK investors. But if you'd invested in America, their stock market went up 18%. So if you had some of your investments in America, some of them here, some in Europe, some, you balance out all the kind of, the differences that go on with the aim of making a return in the long term. The other thing you can do with your investments is you can make a conscious choice to invest in alignment with your values. So there's been a big growth in this recently. I mean, sometimes it's called sustainable investing or ethical investing. There's a lot of different terms at the moment, but socially responsible investing was the kind of first way people had to do this, of kind of choosing investments or choosing tracker funds that were not investing in, say, tobacco or gambling or things like that. Now, funds are generally kind of labeled with this term called, it's a bit, I mean, the financial sector is full of jargon, and this is no different: environmental, social, and governance. So what that means is that they have been rated on how their kind of performance could be at risk by the sort of way they deal with the environment, or their social factors, or their governance. Now, the interesting thing about that is that you could have a company, for example, like BP, who are taking oil and gas out of the ground, so from an environmental point of view, might not be seen to be doing the best, but they could get a high rating, or they have had a high rating for their governance, because they're seen to be really good managers of their people. So this is where you do really need to read quite well. Firstly, it's about sort of deciding what is the most important thing for you. If you're interested, I mean, some people are not interested in where their money goes. I personally think it's really important to know where my money is going, and to, just to make that, just be aware of that when I'm putting my things into investing. So if that is something important for you, it's kind of good to be clear on what are the most important factors for you, and then reading the small print in terms of what they're actually investing in. And you will have to read the small print, because it can be quite opaque. The other thing you can do is that you can do something called impact investing. So this is where you're investing in companies that you feel could have a positive effect on the climate crisis, or something else, for example. So they might be investing in wind turbines or another form of renewable resource. So you might be investing in those. You think, well, I'm not quite sure that this thing is reliable, but I want to make a conscious choice to put my money into this for the future of the planet.
Just a couple of minutes left, Elizabeth.
Yes, okay, great. I'm almost finished, so that's good. Then the other thing to do is, just once you put your investments there, is just leave it alone to grow. So no fiddling or tweaking or panicking when things go down. Remember, investing is for the long term. Boring is totally best. So just leave it alone to grow. And just the last thing I'd like to let you know, that women actually make better investors than men. So we outperform men, even though there's less of it at investing, by 1.8%. And the reasons for that is that we are more conscious of the risk that we're taking. We want to understand it before we do it. We buy and hold things rather than trading and selling things when stock markets go down. And we invest in the long term. Now, 1.8% doesn't sound like a huge amount, but if you compound that over time, it does make a massive difference over time. So thank you very much for listening. Does anyone have any questions?